You throw over $1,000 a month into local wishing wells.
Of course, you idiot, because I'm wishing for more money.
This is the Keeping Your Money Show with Jamie Westenberger and Bart Steindler.
All right, welcome back to the Keeping Your Money Show. I'm Jamie Westenberger, joined as always by Bart Steindler. We've been discussing potential exposure for consumers because of fragmented regulation. We also talked about credit card benefits that are being changed and what you should know about that if you use one of those cards that has some added benefits to it when you use it. If you miss any part of the show, of course, you can always find it on our website. Just go to keepingyourmoney.com. You can also find it on our podcasts, which is located at all of our podcast partners, iTunes, Google Play, SoundCloud, YouTube, and Stitcher, where you can just search for the Keeping Your Money Show.
We were also discussing how much money I should spend on my wife's birthday present.
We were. Have you come to a determination on that?
No, I'm still working on it. Haven't quite got it worked out yet.
Okay.
All right.
Well, keep us updated.
Yeah, I did get her something already, and it's being sent in the mail. So if for some reason, sweetheart, you haven't seen that yet, it might be that one of the neighbors took it. So
Right. And I don't know which one, and it was really expensive, so you're not going to be able to replace it.
Yeah. Sorry about that.
I saw this article, CNBC highlighted, if you don't know who Bill Gross is, he's a huge money manager. He's probably best known as the PIMCO guy. He was there for decades where he managed huge bond portfolios, and a few years ago moved over to Janus to run some bond stuff for them. And the point of bringing this up isn't specifically about him or the performance of his fund or anything like that. But I thought it highlighted something really interesting. And this came up on CNBC. They actually had him on, as well as the CEO of Janus, talking about the fact that he had underperformed pretty significantly this year. And, some of the things they were going to do to try and get back on track and whatnot. But it made me start thinking, how often do we see people who come in and maybe they're invested in something and they've been in it for a long time, and the danger of maybe getting comfortable or even initially purchasing something or investing in something because of a name, right? Mm-hmm. And it can be the CEO of the company really excites you, so you get invested in it. Maybe it's a particular fund because the name is really well known, or it's a manager that you like really well, or maybe it's even your financial advisor. You've been with that person for 15, 20 years, and you just kind of become complacent in whether they're continuing to do a good job for you. And I think it can be a really dangerous thing to get caught up in the name brand of something versus really looking at it with a sharp eye and saying, okay, is this really doing what I want it to do for me? Because I think a lot of times, we as investors, we as the general public, you listening in the car, if I said right now, how have you done this year? A lot of people probably don't know off the top of their head. Mm-hmm. But they probably know, well, I'm invested in this, and it's always been a good company, or that's always been a good manager. But that doesn't necessarily mean that's true going forward.
Right. A lot of the funds that are out there will have a certain person that manages it, and sometimes that person manages it kind of autonomously, and other times they manage it as part of a team. Now, these teams turn over. And when they turn over, a lot of times you get a different philosophy in managing it. So you may have thought, that this one fund, which has performed well over, say, a 10-year period or something, and you're comfortable with it, you understand the basics of it, and it always seems to chug along and do pretty good. But do you really know how it's doing compared to other funds like that? Do you know if the management of that fund has changed?
Has their philosophy changed?
Are they doing the same thing, or are they taking on additional risk to be able to maintain that certain amount of growth? And if the market turns, what's that going to look like? So there's a lot of things that you need to know. You got to dig a little bit deeper. There's been a lot of cases throughout the years I followed investments, which is over 40 years, where it's been there's been some rock star who's kind of been, the guy, the person, the fund that all of a sudden is written about in all the magazines and interviewed on all the TV shows, and everybody's kind of jumping on that bandwagon. Well, what happens a lot of times is that fund or that person maybe is successful in a smaller scale, but as their fund grows and grows and becomes bigger and bigger and more people invest in it, it becomes much harder for that person to try to make that same type of performance, because they have to find so many more good investments. It reminds me of a conversation I had one time with someone who was talking about, fund managers, and saying that, the fund manager has his 5 or 6 best ideas that he puts into the fund, but he has more money than his 5 or 6 best ideas. So then he has to go to his next 5 or 6.
He'd own the whole company if it was just his best 5 or 6 ideas.
Right. So he has to go to his next group of 5 or 6 ideas and his next group of 5 or 6 ideas. And the bigger that fund gets, the further down the path of the best ideas he has to go, and it makes it harder and harder for him to be the rock star that he was when that fund started out. So, you have to take all those things into account.
Well, I think it can go over to individual companies too, right?
Absolutely.
You can become enamored with somebody like a Jack Welch who, ran GE, like just an amazing man, amazing way he ran the company. Well, he hasn't been there in 30 years. So that's not the same company it was when he ran it.
And the stock price reflects that.
Right. And that's not to say that GE is or isn't a good investment. It's just, it's different than it was when he was there. You might be really excited about a young company when it first starts out, but as it grows in complexity and the way that it does business and things like that, it may become a totally different company. And I think of some of the tech companies that, they started out with, a few million subscribers, and now they have a few billion subscribers. That's a totally different company than the day you invested it. Not to say that it's not still potentially a good investment. It's just not the same investment as it was when you bought it. I think the other thing that this can flow over into is when you're looking at purchasing a new investment, whether it be a fund or an individual stock or anything like that. What are you looking at to make that decision? If the only thing you're looking at is the track record of that investment, you have to ask yourself, what is different, what is the same today as was when this track record was established? Because like you were saying, Bart, you could have totally different management at the helm. And I think back to, the 80s and 90s, there was a particular fund that was just, everybody had it, and it doesn't matter what it is, but everyone had it. Everyone had to be in it. It was in every 401k out there. I don't think I ever hardly talked to anybody that wasn't aware of what it was. The main manager left. He went and started his own company. People kept going into that because of what it had done over this 15-year, 20-year stretch. But it did that with a guy that's not even there anymore. you know? So when you're looking at investments, and this is where I think, a lot of times people will say, well, I can get the same information online, and, where does a financial advisor benefit me? This is one place where I think a financial advisor can be a huge benefit, to be able to sort through all of that information and point out those types of things to you, that you're right. You were doing great in this particular family of funds for a number of years, but you know what? In the last 4 years, man, have they underperformed so many other things out there. Why are we still in that investment? We can't be looking at, there's a saying in our industry, and it's kind of like a disclosure that gets said, but there's a lot of truth to it. And that is, past performance is not indicative of future results, meaning it doesn't matter what happened last year. Tomorrow is a whole new day. And if you have different management, different philosophy, different size, like you mentioned, if you buy into something when it's a $10 million company and now it's a $10 billion company, that's a big difference in the way that is going to be run, and it can have a huge impact on your overall performance and your success or failure.
Yeah, a lot of times people come in for a review after a year, and we take a look at how their portfolio has done, and they'll want to say, well, this particular segment of the portfolio did really, really well, and this segment over here didn't do so well. So I want to take the money from the segment that didn't do so well and put it into the segment that did really, really well, because they're having that concept that they're chasing the leader of last year. And that's a mistake that you can make. If a lot of times you're at the end of a year, if you're reviewing your portfolio, there probably should be parts of your portfolio that did not perform as well as others.
Yeah, because you're diversified.
Right. That's perfectly normal, and that's healthy. That's a good thing. That's not a bad thing. And you shouldn't make the mistake of trying to take it and chase it, because what you're doing is you're unbalancing your portfolio when you do that, and you're changing what the risk level is. And you could end up with not such a good picture. You should look at more of what is the return adjusted for the risk I'm willing to take, instead of how did this part do versus that part.
Yep. Well, I want to remind you, if it's been a while since you've looked at what you're doing, maybe you need a second opinion. Maybe you've been working with the same person for a number of years, and you just don't even know if your performance is in line. Do you even know what your retirement income strategy is? Okay, you have this big chunk of money, but now what? We did town hall education meetings last week, and the number one question that kept coming up is, do I have enough money? How do I turn my money into income? Mm-hmm. It seems to be the thing that everyone really doesn't know. And if you don't know that, then how do you know if you're doing a good job or not? Mm-hmm. And I'd welcome you to give us a call. 888-98-MONEY is the number, 888-986-6639. We'd love to sit down and show you a real simple breakdown of what you're doing. Are you on target for your goals? And how much income can you expect in retirement? And where's it going to come from? Give us a call. We'd be happy to help you. All right, coming up, we're going to talk about 3 lethal investing mistakes you are continuing to make and how to stop making them right here on the Keeping Your Money Show.
Is your 401k sturdy enough to help support your retirement goals? The Keeping Your Money Show has a team of advisors that will help you size up the assets currently in your 401k and explore asset allocation based on your goals. Call the Keeping Your Money Show today at 1-888-98-MONEY or visit keepingyourmoney.com to learn how you can start solidifying your foundation for a strong retirement plan.